The last piece, which I want to spend a few minutes on, is the idea of opportunistic or tactical risk management, and this is really critical because this goes back to, in a nutshell, it says, do we have dry powder to invest when we need to? And if you look at some of the large investment banks in the U.S., one of the areas that J.P. Morgan, for example, has always done an exceptional job of, and if you look at their performance over time, is that through their risk management, they have always managed to keep a substantial amount of dry capital to take advantage of market dislocations. And there are several examples. It happened post 2008, where they were one of the banks that were least affected by the subprime crisis, and their ability to take advantage when all the other banks were in recovery mode, they were in a much more aggressive position for taking on risk, etc. So having dry powder, knowing when to opportunistically apply the dry powder, etc., becomes a very critical part of the overall capital allocation, capital reserving, sizing, etc. So go to the next slide, please. Sorry. Yeah. Now, without belaboring this point, the high yield credit market, and I think Nick spoke to this earlier in the beta hour, is a proxy, if you will, for the availability of funding, especially for the riskier credit universe. And this, if you look at these cycles, this is really looking at, I would say, look at the blue line, which is really looking at where spreads have been. And if you look at the various cycles that we've gone through in the last 25 years, the more recent cycles, which is the global financial crisis, leaving aside the oil price collapse, that was fairly nuanced, but the post-COVID-19 scenario where you actually have a drying up of liquidity completely, credit spreads have widened to their historical wides. And the question is there a way for us to be able to take advantage of these wide credit spreads opportunistically? Okay. In India, of course, we've had not only the overall shallowness, if you will, of the credit markets, but also ILFS and the resulting implication on liquidity and the impact this liquidity has had, or the lack of liquidity has had on the credit markets. So with that, we'd spend the next few minutes on the structured credit business, which I think is a good way to express this idea of opportunistic risk taking within Alpha.
So coming to where we are in the credit market, clearly the situation is that there is capital which is short in supply. Historically, we had NBFCs which played a very important role on the structured credit side, but that has changed post the IL&FS crisis because NBFCs today are dealing with two issues really. One is the liability side, where there are lack of funding lines. Banks have effectively jammed their credit lines to NBFCs. And the asset side liquidation issues in terms of assets which have become NPA, to sort of realize the funds back and go, while going through the entire legal litigation process has become extremely painful. As a result of these two events, most NBFCs today have significantly reduced fresh disbursements. And in fact, the larger problem is that they're exiting the wholesale credit space. So you've got Piramel, Edelweiss, Indostar, all of them talking about just winding up their wholesale credit book and moving to retail credit. So NBFCs on one side and banks, which are now not even looking at assets which have turned NPAs. And we're seeing that more in the context of public sector banks, given the whole regulatory scrutiny risk if they decide to fund a non-performing asset account. So with both where banks and NBFCs are in terms of lending, clearly brings out a very large opportunity which can be tapped today. Shan? So while everybody is talking about a large opportunity, we continue to see risks which are being discounted and which we need to be very mindful of when we embark on this journey of building out a credit book. And the way we look at it is there are three large risks: the refinancing risk, the collateral value recovery risk, and the enforcement risk. So just going to the refinancing risk, historically, the way the stressed asset movement worked, whenever an account turned NPA, it first went to a distressed asset fund, which is nowadays often referred to as a Cat 2 fund. And that account stayed with the fund for about 12 to 18 months, post which it moved into the NBFC system. The NBFC system, what it did was it gave a formalized structure to the account, because then there was a formal evaluation of the credit score and the CIBIL score would get upgraded because the asset was in a regulated system in that sense. And from NBFCs, after 12 to 18 months, it moved into the banking system. Now with the NBFC system going slow, what we are seeing, while people are assuming that things will normalize and NBFC lending will kickstart, we strongly believe that the middle layer is going, and it will become increasingly difficult for stressed assets to find their way back into the banking system, as we see in the next 2 years. The second risk which we feel is really apparent is the collateral value recovery risk. And we're seeing a lot of cases where funding has happened against land, immovable property, and the problem is not just drop in value. There are no takers for these assets right now. So you've got a lot of companies, a lot of lenders coming to us and talking about land parcels, buildings, etc. But frankly, finding it very difficult to get a buyer to buy those assets, which is why a lot of lenders are struggling. And third risk is, of course, the security enforcement risk. A couple of years back, people were talking about IBC, the NCLT process. But today, going to an NCLT process is a big no for every bank because of the uncertainties in the entire process and the timelines involved in sort of getting the asset out. So what are we looking at in this space? We're looking at transactions which are in the nature of OTS funding, where large discounts are given by banks and the asset becomes sustainable. We're looking at special situations, inorganic acquisitions which the promoters want to undertake. We're looking at last mile funding, projects which are 90-95% complete. There is visibility on the completion plan. There is visibility on the cash flows once the asset is completed. These are the set of transactions which are very, 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 very active in the market, as we see. But we are not looking at a situation where we will do a plain vanilla mortgage lending. And the reason for that is we strongly believe that enforcement becomes a very important criterion, and being able to enforce at the right time and not delay it, which impacts our IRR, is very important is a very important element if you have to build out a business or we have to undertake a transaction of lending. So our deals will be are a combination of partial assets which are owned by us and partial assets are mortgaged to us. So what that does is it becomes very easy to sell an asset which is owned by us in a situation where things are going south. And what that also does for us is that it keeps the ill-intentioned promoters out of the equation, because normally the ill-intentioned guys are not comfortable with parting with ownership of their assets. So designing structures which sort of give us the ownership is an important element. And the second part of the structuring is building in enough poison pills to actually ensure that we have the lowest exposure. We are the most costly lender in that sense, and we are the most painful lender. In other words, promoter doesn't have a choice but to repay us. The third important part to this is the target companies. So what everybody else would have done, lending against non-operating assets, is something we are not looking at doing. We focus a lot on companies which have strong operating cash flows, because that sort of increases the avenues for recovery of our funds, which then we are not effectively relying on asset sale to be able to get repaid. A strong operating cash flow always ensures that there is a lender who may be interested in coming into the asset and taking us out. Lastly, and I think this is the most important point, being the exit mechanism. So the structures that we are trying to create are in a manner that we can get a simultaneous funding from banks. So what that does is two things again. Banks, when they come into the asset, they fund up to 70-75%. So our exposure reduces to 25%. And with a banking line, which is a 10 to 15-year line at a low cost, the asset becomes naturally sustainable. So essentially, there's no ambiguity on the exit, really, on the large part of the facility, because 75% is really upfront facilitated through the bank coming in. And the second thing it does is it creates a win-win solution, because the promoter also is looking at to us as a partner and not as an adversary, because we are trying to solve this problem of getting an entry back into the banking system. So I think these three elements of the right deal structure, the right target company with strong operating cash flows, and creating the right exit mechanism will be very important as we go along and build out this structured credit business.
going off mute. Huh?
Yeah. So in summary, what we've tried to do in this hour is to demonstrate how risk management can play a role as a source of alpha on during our investment management process. We began the session with an overview of market structure risks, which we believe are different to vanilla risks. These market structure risks can create unexpected large drawdowns, and understanding how these can actually be how we can protect ourselves from these large drawdowns by taking advantage of certain dynamic and static risk management strategies to mitigate these risk factors. And last but not least is also recognizing that capital allocation is a key part of how we not only take advantage of opportunities in the market, but also prevent ourselves from having excessive exposures to individual positions. So all in all, I think when we look at the compendium of solutions that we have that are characterized by these three buckets, it allows us to then capture, if you will, a number of risk management strategies and hopefully convince you that this is a source of alpha in our investment products.